Good morning. Welcome to the B.F. Anderson Technical Report for January 23rd. Again, I want to emphasize how important trend is. Trend is your friend. You want to always pay attention to the trend. And you can see here with the NASDAQ is very strong uptrend. These moving averages are very consistent, very healthy. A little bit of white space in here, but things look good. Now, we are extended to the upside. There's no doubt about it. However, how hot is hot and how cold is cold. You don't know how long these trends are going to last. They could last for years. You just don't know. So the main message here is just be aware of the fact that the trend is up. Don't fight the tape. Now, I keep mentioning this ratio every week, and it's an important ratio because no strategy is going to dominate all the time, because if a strategy works all the time, then everybody would use that strategy and then it wouldn't work. So it's auction markets is what you're dealing with here. Now, as you can see here, the growth stocks had a 28-month outperformance cycle. Well, that meant that the value stocks, the other strategy out there, there's primarily two strategies, growth and value, that meant that the value guys underperformed for 28 months. So there's a study out there done by the American Association of Individual Investors that basically says that your brain is your worst enemy, meaning that they did a study that asked the question, how much time does it take before a typical investor gives up on the strategy? Well, the results of the study was 18 months. So I thought it was really interesting that this last underperformance cycle that we went through, where the value stocks came back on board and outperformed the growth stocks, it was exactly almost to the day 18 months. So all of a sudden everybody throws in the towel and it reverses. So far the growth stocks are starting to outperform. Let's hope that continues. Now on the MACD indicator, you can see here at the bottom of the page here, at the bottom of the graph, that we are continuing to see building momentum. This is a momentum indicator. So we've gone from negative momentum from the bear market last year, and we're now in positive momentum on the S&P. But even more importantly, the market is starting to broaden out because the Value Line Geometric Index is a very broad index, equally weighted, because we have to realize that the returns last year were primarily driven by three stocks, Microsoft, Apple, and Google. And the market was not broadening out. But when you start to see that the Value Line Geometric is starting to break out, and we're seeing improvement in the MACD, which is showing increased momentum, that's a very good sign. Now, another good sign is the global stocks. Internationally, things are starting to improve. Again, we've got a MACD buy signal, and we just got the buy signal on the MACD back in December, and it's continuing to build here in January, and we're very close to breaking out to an all-time new high on the global stocks. Very positive. China, now we all know about what's going on with their health conditions. The coronavirus is definitely on everybody's mind right now, but China is starting to show some signs of life here, where we went into a really difficult bear market for the Chinese stocks, which have now pretty much reversed, and we're starting to see positive momentum. Now, they just gave a buy signal in December as well. Small caps, same basic story, and we're going to talk a little bit more about the aversion of risk and having a risk appetite. Well, the small caps, as anyone would know, is that when the small companies start to move, that means that risk appetites are starting to increase. So as you can see here with the small caps, we didn't get the buy signal in the small caps until just this month, January, but we are seeing improvement in the small caps. Now, sentiment, which is fear and greed, this is the put-call ratio. This is the option equity put-call ratio. We know that institutions hedge their portfolios using options. When they're buying a lot of calls, they're very optimistic. When they're buying a lot of puts, they're pessimistic. Well, you can see here that this indicator is really off the charts, meaning that it's red hot. There's a lot of call buying going on. There's a lot of optimism here. But realize that sentiment is a secondary indicator. Trend is your primary indicator. So just be aware of the fact that there's a lot of optimism out there. That's usually a sign of trouble, but the trends, this can stay this way for a long period of time. That's my point. Now, on emerging markets, I thought I would pull this graph up real quick just to mention basically that emerging markets have been underperforming the S&P 500 for approximately 10 years. It's been a real long period of time that these stocks have underperformed. And as I've said in the past, I'm not a big patterns guy, but I do pay attention to patterns. And so we've gone through a real long period of time of consolidation of these stocks, of the emerging markets. In other words, the point of looking at the emerging markets is not necessarily to say, hey, we should go invest in emerging markets. The point is that it has to do with risk aversion and risk appetites. When risk appetites pick up, you're going to see a pickup in the emerging markets. So what we're seeing here is a pattern. And if we go back and look at, if we go back to like 1998, you see a low, and then we rallied, and then we made a higher low. Then we broke out of the consolidation, which was approximately 8 years. This was an 8-year consolidation of the emerging market index. It then broke out, had a false breakout, which we would call a crouch. It basically crouched and then rallied 194% from this point to this point. Now, since 08-09, we have been in a 12-year consolidation. So actually this consolidation, this base is longer than this base back here. Now we're seeing the same pattern. You're seeing a low, you're seeing a higher low, you're seeing a breakout, a pullback, and now breaking out again. Now you can look at this consolidation and see the difference between the two. This was very broad because this was the 09 crash. But recently, actually since around 2010, this base has really tightened up, which is a good sign. So what we're saying here is the emerging markets should be observed because as long as they continue to perform well, it's telling you that risk appetites are increasing, not decreasing, which is what we want. Now, this is the IBD 50, which is 50 growth stocks. Has not made a new high. This is the high that it made, last year back around October. Big drop. We've been in pretty much a period of consolidation here, but this particular fund, which is the 50 top stocks, growth stocks in the IBD database, this indicator is starting to break out and is actually broken out above a consolidation. So that's a positive. Also, I'm mentioning here, this is another ratio that we're looking at. This is the technology sector versus consumer staples. You can again see very strong uptrend. Growth stocks are definitely starting to outperform here. All right, so let's look at the top 5. Now remember, the top 5 is not a buy list. This is nothing more than something to observe. And we're seeing again that advanced micro devices, which is semiconductors, continues to be strong. This is a biotech company, Axum Therapeutics. Continues to be in an uptrend, however, starting to consolidate. Bristol Myers Squibb, pharmaceuticals. Pharmaceuticals are acting much better. Really pretty chart. You must admit, that is a very nice, steady uptrend above that 10-day moving average. This is another company in the aerospace industry called Transdim Group. Again, really pretty chart here. Very steady. A little bit extended, but looks good. Now, Tesla. Tesla has been red hot. You have to really understand the speculation here. The speculation is that will there be some type of breakthrough in battery technology or artificial intelligence or whatever that's going to cause a migration away from the internal combustion engine towards battery electric vehicles. And what's going to happen possibly with their energy business, which we're hearing could actually be larger than the car business, which is where you would be able to power your home using battery packs. So far, the stock is acting real well, has broken out, almost hit $600 a share yesterday. Probably due for a pullback, would not be surprised. So be careful with this one. So all in all, what I'm saying is we're starting to see continued improvement. Remember, the trend is your friend, and sit tight and continue to stay fully invested until that trend reverses. Thank you very much.